Hello and welcome. You're watching Market Cafe with me, Ankita Saxena, and with me is my co-anchor Snehi Shah. Fresh week of trade, Snehi. But first up, Friday, what happened in the Wall Street? I believe the markets were pretty flattish there.
Absolutely.
But we did see the gains coming in for the week, right?
Absolutely. So good morning, Ankita, and good morning to all our viewers. Let's kickstart this week of trading with a bang then. And let me take you through the global handover. Let's start with the US markets then. And S&P 500 futures came in rather flat and they were like almost unchanged on Sunday evening as investors awaited a batch of key earnings report and a major policy decision from the Federal Reserve. On Friday, the blue chip Dow eked out a very nominal 2.5 points gain. Mind you, this is not percentage, this is points. A very flattish but trading with a positive bias, so it finished higher for the 10th day in a row and marked its longest rally since 2017. Now the S&P 500 finished the week up by 0.7%, while the Nasdaq Composite on the other hand fell 0.6%. So that fall continued for Nasdaq, and investors anticipate the Fed will increase rates by a 0.25 percentage point at the conclusion of its meeting on Wednesday. So for us, in Indian time, the outcome of that meeting will come out by Thursday, and they will be listening to comments by Chair Jerome Powell to get a sense of the central bank's position on what happens next as it tries to navigate a soft landing for the economy. Now, US market watchers are also watching out for the Personal Consumption Expenditures Index, that is the Fed's preferred inflation gauge, which is due at the end of the week. Now, the week ahead is also set to be the busiest one of earnings season, with Thursday being the most intense day for the US markets because about 40% of the Dow and 30% of the S&P 500 will give their financial updates during the week, including Alphabet, Microsoft and Meta. Now, several big pharma companies are also getting ready to report, and it's going to be a big week for industrial companies in the US as well as oil. So, it'll be interesting to see what the numbers come out and how that pans out for the US markets. But let's quickly shift focus to Europe then, and European markets closed higher on Friday as investors digested a fresh round of corporate earnings and looked ahead to a crucial Spanish election over the weekend. We'll talk a little bit more about these elections as we go ahead in the show, but the Pan-European Stock 600, that index closed 0.3% higher, with most sectors in the positive territory. Household goods added 1.2% to lead gains, while it was the mining stocks on the other hand that shared 1.5%, so big losses coming over there. And FTSE saw an uptick of 0.2% as well. Corporate earnings for Europe on Friday came from Swiss miner Glencore, and earnings season will kick off in earnest in the next week when Europe's major banks, pharmaceutical firms, automakers, energy giants, as well as aircraft manufacturers are all due to report their earnings next week. So, largely flat handover coming in from both US as well as Europe. We only have the Dow that's continuing its rally. Other than that, pretty flat handover coming in, Ankita.
That's correct, Snehi. But if you look at the oil prices are really seeing an uptick, and likely they're going to continue to see the uptick because the supply is beginning to tighten now, and that is going to really give a boost to the oil prices. And also on Friday, oil prices rose more than $1 a barrel, buoyed by growing evidence of supply shortages in the coming months and rising tensions between Russia and Ukraine that could further hit the supplies. Now, the oil market is starting to slowly price in the looming supply crunch as it is on track for its fourth week of price gains. If you look at the Brent crude has well touched the $80 mark. It is currently at $80.65 a barrel, and the WTI currently stands at $76.69 dollar a barrel. And that is what is really giving a boost to the oil prices. A tightened supply chain and the looming war crisis, that is something that you really need to watch out on, because oil does have a bearing on the markets as well as the Indian companies, because oil is an important commodity for a lot of Indian companies as well. So oil is something that we really need to keep a track of.
Absolutely. All eyes will be on oil this week, but let me also take you through all the cues that you should be keeping on your radar for the entire week, because let me warn you, it's going to be an intense week ahead. And let's begin with global events then. On the 26th of July, you've got the FOMC rate decision that will be coming out. 27th July, you've got US GDP numbers. And on the 27th as well, you've got the ECB rate decision that will also follow. On the earnings front, today you've got Tata Steel that will be declaring its Q2 numbers. Tomorrow you have the likes likes of Bajaj Auto, Asian Paints, SBI Life, Tata Motors and L&T declaring its numbers. Followed by that, on 26 July, you've got Tata Consumer Products, Bajaj Finance, Tech Mahindra, Dr. Reddy's, Cipla as well as Axis Bank declaring its Q2 numbers. Followed by that, on 27 July, you've got Nestle as well as Bajaj Finserv that will be declaring their earnings. So a very earnings heavy week is lined up ahead for us. Lots of action on the street as well. On the corporate action front then, on the 20th of July, you've got on the 25th of July, you've got CEAT, which will be mulling proposal to raise funds. And on the IPO action front, then on the 26th to 28th of July, you've got Yatharth Hospitals that will be opening its IPO for subscription. 27 July, you will have Netweb Tech that will be listing on exchanges. So a very intense week ahead of us. Lots of action happening on the street. Will be interesting to watch.
That's right, Snehi. A lot of action. That's right, Snehi. A lot of action. Corporate earnings in the US market and in India as well. So that's something that we all will be watching out and tracking very closely. But let's go across the first cue this morning that the world has set eyes on. The biggest box office face-off in years, Barbie versus Oppenheimer. Christopher Nolan's Oppenheimer has clocked in $80 million in US and $93 million from 78 international territories for the global debut of $174 million, nearly doubling the $100 million worldwide haul that it was projected to deliver going into the weekend. Barbie, on the other hand, has generated a record-breaking $155 million and a global debut of just over $337 million.
Right, and as discussed earlier, let's talk about the Spanish elections. And tight political drama from Spain eases after the Conservative Party has bagged the most seats but have failed to gain an outright majority in the parliament. The Socialist Party, on the other hand, faring better than the most, and the right-wing bloc only managed to secure 169 seats, with the left wing winning 153 seats. In turn, both parties have fallen short of forming an absolute majority.
And well, Twitter once again in the spotlight as Elon Musk says he plans to rebrand the platform, reflecting the billionaire's vision to create a super app. The well-known Twitter logo might be replaced by an X logo, and soon we shall bid adieu to the Twitter brand, and gradually all the birds, tweeted Musk.
Alright, and on to an ET Now exclusive then. We learn from reliable sources that Bain Capital has signed a deal with Adani to buy Adani Capital. My colleague Anurag Joshi joins in with more details. Anurag, take us through this deal.
Yes, US private equity firm Bain Capital has signed a deal with Gautam Adani's family to acquire Adani Capital, the non-banking financial company owned by family firm Adani Finserv. Sources told ET Now that Bain Capital signed the deal on July 20 with the Adani family to acquire Adani Capital. The acquisition value, sources are telling us, is around 1,600 crore rupees, which is 2 times the net worth of Adani Capital. Bain Capital had put a binding bid for the proposed acquisition, and it was competing in this transaction with 2 other potential investors, which are a peer US private equity firm, Carlyle Group, and Cerberus Capital Management. Now, Adani Capital, in terms of the asset size, is one of the smaller NBFCs in the country, and it had a total assets of about over 2,000 crore rupees. This was as of March 2022, and that's according to the annual report of the company.
And well, moving on then, a group of 30 Indian and foreign investors backing online gaming companies has written a letter to PM Modi about the current proposal of imposing 28% GST on online gaming transactions. And the letter also states that not only will the current GST proposal lead to a potential write-off of the $2.5 billion capital invested in this sector, but will also impact the future funding of the sector. My colleague Sumit Chaturvedi tells us more about what the top demands of the investors really are. Over to you, Sumit.
A group of 30 investors, including Tiger Global, Kalari Capital and other major investors in online gaming sector, they have written a letter to Prime Minister Modi of India. They have demanded overall looking into the the recent decision of 28% GST on online gaming, the full face value of online gaming. Well, they are of the view that this decision, proposal, it's now and going to go to monsoon session of Parliament. This will, in a way, lead to destruction of the sector. They have also said that this can lead to job loss of 50,000 people. So far, there can be a loss in value of $2.5 billion and $4 billion investments that could have come will not come. This all has been said in the letter. We all know that around a fortnight ago, GST Council meeting had proposed 28% GST on online gaming, full face value of online gaming and casino and horse racing. And since then, the online gaming industry is up in arm against the proposal. And this time, the investors have written this letter to PM Modi seeking a meeting with him. They are also of the view that without this 28% GST, they were doing well, and it could have actually resulted into making India an export hub for the crucial online gaming sector. But this decision has been taken, and it's going to adversely impact them, and that's why they're seeking a rollback. If not rollback, well, PM should even look into the whole matter. Well, that's what earlier also being asked from different ministers, and Rajiv Chandrasekhar, well, he was of the view that they can look into or maybe even can propose it, but it's still so difficult to say. Nothing is going to happen as far as online gaming sector is concerned, and 28% GST on this crucial sector is concerned. But 30 now investors have written a letter to PM Modi, and that's what the latest development is.
All right, thanks for all those details, Sumit. With that, let's quickly slip into a very short break. We'll come back with what the Asian markets are doing on the other side.
Welcome back. You're watching Market Cafe. Now, it is that time of the show where we go domestic. But before that, let's quickly take a track of how the Asian markets have opened. Well, the Asian markets are taking a cue from the global markets. A mixed global handover coming in there, as Snehi mentioned. But the Asian markets also look mixed. Now, we have we have a slew of economic data that's likely to come out of the region, including inflation numbers from Malaysia and Singapore. Japan will also see a release of private surveys for its Purchasing Managers Index for the month of July. And on the back of that, we do see Nikkei gain 1% in trade. It's up 401 points. We'll go to Kospi. Kospi is also opened up in the green, actually. And Kospi is up 0.5%, slightly more than 0.5%. However, we do see Shanghai and Shanghai in the red. It has opened, it's very, very flat, but in the red, down 0.1%, 4 points. And we also see Hang Seng also is down 1%. So Shanghai and Hang Seng have opened up in the red. The Kospi Nikkei in the green. Mixed handover coming in there. ASX 200 again in the green. Very, very flat. Just up 6 points. And if you look at GIFT Nifty has eased off the gains. It had opened up in the green, but now has slipped into the red, down 29 points. Very, very flat. It is hinting towards a rather tempered start for the Indian markets as well, Snehi.
Absolutely tempered start for our markets. Let's see how the GIFT Nifty pans out during the day and how that implies for our market as well.
Welcome back. You're watching Market Cafe, and now let's move on to news coming in on the domestic front. Well, big boy Reliance posted its quarterly results that was in line with the analyst expectations. Profits for the quarter came in at 16,011 crores, down from 19,299 crores on a quarterly basis. Now, retail and oil and gas have put up a brave fight. Meanwhile, Jio saw an ARPU of 180.50 in the quarter gone by. Now, Reliance announced a dividend of 9 rupees per share. My colleague Somit is here with the fine print of those numbers. Take it away, Somit.
Well, pretty much inline set of numbers coming in from Reliance Industries in the first quarter of FY24. EBITDA margins coming in at a 12-quarter high. When it comes to segment-wise performance, it was the O2C segment which led to a sequential decline, while the other segments have grown on a sequential basis. Now, the decline on the O2C segment was largely on account of lower gross refining margins and lower exports in the first quarter. When it comes to the gas exploration business, we have seen a growth on a sequential basis, and this is purely on the back of higher production volumes and and sales volume. When it comes to the retail segment, the growth was on the back of store expansion and higher footfall. The company added nearly 406 stores in the first quarter of FY24, while the store footfall and the number of transactions increased nearly 14% and 7% on a sequential basis. Now, on the net profit front, if you see on a consolidated basis, the fall seems to be a bit higher, but that is largely on the back of the fact that the tax expense for the company in the first quarter was also higher. If you see, tax expense in the first quarter stood at close to 25% as against 11% seen in the previous quarter. On the capital expenditure fund, that was down nearly 11% on a sequential basis, while the company's net debt largely remained stable. When it comes to Reliance Jio, again a pretty much inline set of numbers. Revenue EBITDA higher by nearly 3%. Margin came in at 52.3%. ARPU number was also in line with street estimate at close to 180.5, while the subscriber base grew to around 44.85 crore. Now, do remember, this is the 5th consecutive quarter where the company has been able to grow its subscriber base, and the subscriber base, if you see the addition that we have seen in the first quarter, was the highest in the last 4 quarters. So pretty much inline set of numbers for Reliance Industries, and brokerages have also largely maintained their stance and opposed the earnings that the company has reported.
All right, thanks Somit for all those details. So retail and gas slightly ahead for Reliance Q1 earnings, while Reliance Jio's numbers have come largely in line with estimates. But my colleague Ajay Sharma also spoke to industry experts on the first cut of these numbers. Here's a slice of that conversation.
15,271 against 16,293. Oil and gas is 4,015 against 1,301. Retail is 5,151 against 4,925. Digital services 13,721 against 13,388. And others is 2,267. So total is 40,425 against 40,270 in the previous quarter. This is total segment profit before interest, tax, depreciation, amortization and depletion. So if you look at quarter on quarter, oil to chemical is down by 1,000 crores compared to the previous quarter. Oil and gas is little flat. Retail is EBIT level higher by approximately 70-80 crores. Digital is up by 200 crores. And others is up by 500 crores. So if you break up, it's not much of an impact. The market was estimating a lower number on oil to gas, which is more or less fructified. But looking at the number, my personal take is that the GRM number won't be as bad as what the street was estimating.
O2C EBITDA was expected 4 to 5% lower, around 15,500 or thereabout. So they have actually been slightly on the better side. Maybe the street was penciling in slightly weaker performance and numbers are not as bad. Naveen, how did Jio do in your view? ARPU numbers not out yet, but what would your estimate be?
Yeah, so I would say that the O2C business, which is the reported number, which is around 15,271, let's say I were to look at it on a sequential basis, the GRMs were, of course, in this quarter lower. So we are looking at around $9.5 GRM. So we're looking at around 7 to 8% decline on a sequential basis for the O2C business EBITDA, right? That number seems to be down by almost by around just around 1,000 crores, which is around 6% down, right? So I would say that this number is slightly better than what we were expecting. So this number is not definitely not bad. The other, of course, business, which is, as I indicated, the digital services and Jio business, that was, of course, in line. Retail business, again, I would say that has grown sequentially, so it's a decent number, right? We expected a slightly better number than what has been reported. It could have been slightly better. But overall, consolidated EBITDA number, we are expecting around 38,000 crores, so that's coming at around 40,000 crores. So that, I would say, is largely in line with our expectations.
The expectation on retail EBITDA was around 5,000, just above 5,000 crore. That actually has done pretty okay. And this is despite no festive season. Footfalls seem to have done well. Mayuresh Joshi is also here with us. Mayuresh, let's get your view also coming in. Start by talking about how the retail EBITDA at 5,151 is sequentially higher by almost 5%.
Evening, Ajay. I think it's a tad bit better because, as you rightly pointed out, I think the street was of the belief that it should be close to that 5,000 odd mark, 5,000, 5,050. So maybe 100, 150 crores sequentially better off than what a lot of analysts on the streets were estimating. And crossing 5,000 itself is a huge, huge number.
And well, Well, keeping with the earnings, private banks like Kotak and ICICI also reported their Q1 results. Now, how have they performed? My colleague Harsh joins in with all the number crunching. Take it away, Harsh.
Well, yes, let me quickly take it to ICICI. First off, your net interest income went up a solid 38% year over year. You also saw operating profit go up largely in the same line, 37% higher. Both of these numbers in line with what analysts were penciling in. Where the real surprise has come in is that provisions number. It was at around 1500 odd crore in Q4. It's come down to 1292 crore. It was expected around that range. So, that the decline is definitely a plus, and that decline is really impacting profitability. So, you've seen your profit after tax numbers go up and go up quite well. That number has come in at around 9,650 crore, which is a very solid 40% jump on a year-on-year basis. Again, largely in line, but slightly on the higher side, that profit after tax number. You're looking at GNPA ratios, which have come off around 5 bips or so, and NPA largely flat, stable. And credit growth is quite strong, 18% growth on the advances as well as the deposit side. Advances is no real surprise, the 18% number, but deposits definitely a positive. Your NIM has compressed from 4.9%, it's come down to 4.78%, but not compressed as much as many were really penciling in. So that's the other plus essentially coming through. Let's also have a quick look at how Kotak has done. Kotak has also done fairly well. It's a fairly stable, result overall from Kotak Mahindra Bank. Essentially, what we are seeing in terms of the growth is your NI has gone up around 33% year over year. Your operating profit has gone up 78% on a lower base. You had a quarter, which Q1 of FY23, which had some treasury losses. That has now reversed in Q1 of FY24. In fact, there's a treasury gain. You're seeing provisions which are slightly elevated compared to what expectations were, and profit after tax has come in at 3452 crore. Roughly 3200 crore is where we had penciled that number in, so definitely on the higher side. You're seeing GNPA and NNP ratios come in slightly above what most were anticipating. Advances growth remains strong at 19%, and deposit growth, again the surprise, at 22%. NIMs have again compressed around 20 bips or so to that 5.57% mark. Again, largely in line set of numbers from Kotak Bank as well.
All right, thanks Harsh for all those details, but stay with us then, because Paytm has also reported its quarterly numbers, and on a sequential basis the net loss has widened to 357 crore from 168 crore. Meanwhile, revenue has seen a marginal uptick in the quarter gone by. So Harsh, take us through these numbers for Paytm.
Well, yes, so I'll first off comment on the PAT. PAT has, or rather loss after tax, or after tax losses have widened largely because it's a one-off. It's an IPL knock which has seen, so marketing spends were slightly higher in this quarter, not exactly a comparable in terms of that OPEX number, but revenue continues to go in the right direction. 2342 crore is where that revenue number is. Quarterly, largely flat. Payment services revenue has come in well above. It's come in at 1414 crore. So that's a plus. You are seeing payment margins continue to remain in that 7 to 9%, 0.07 to 0.09% band. So that's again a plus. They're able to maintain those margins. Financial services revenue has come in at 522 crore, which is around a 10% growth on a sequential basis. You're seeing commerce revenue also largely flat. Commerce and cloud. Your contribution profit has gone up, again largely in line with what the street was penciling in. 1300 crore is where the contribution profit has come in at. Contribution margins at 56%. You're seeing EBITDA before ESOP at 84 crore, which is a solid 62% jump. When I'm looking at it year over year, you're seeing margins get better. Sequentially, your EBITDA margins have literally doubled from 2% to 4%, but loss obviously has widened because of that higher OPEX number, and of course some amount of an ESOP knock as well coming through. So on the back of that, of course, Paytm will be in focus, but losses slightly higher than what most were penciling in, around 20% or so.
Now a little bit about our loan distribution business. Our value of loans distributed through Paytm platform last quarter was just under 15,000 crores, which is a number that we had published in our monthly operating metrics. So this is a number that you already have. And this has seen significant growth across all three products. So Paytm Postpaid is up 138%, personal loan is up 202%, and merchant loan is up 232%. So we are seeing traction across all three of our products. As we have mentioned before, starting, I think May 22 is when we explicitly called this out, that our focus is on improving credit quality. One of the things that we are quite proud of is that the penetration levels are still very low, which means two things. One is that there's a huge addressable opportunity ahead of us, and also that we are very selective and when we work with our lending partners on who gets a loan on Paytm platform. Another indication of this is that the portfolio performance for our partners has continued to improve. Specifically in Paytm Postpaid last quarter, we lowered the range for expected credit loss with our partners. And this quarter, again, we are lowering the ECL rates range that we are giving. Earlier, it was 75 to 100 basis points. Now it is 65 to 85 basis points. So we are seeing consistent improvement in credit quality as a result of a number of business initiatives that we have taken.
Well, moving on from one new age tech to another. Troubled edtech major Byju's has reached a tentative agreement to rework its loan pact with lenders who collectively own more than 85% of the $1.2 billion Term B loan. People aware of the matter told The Economic Times. Now, a Term B loan typically is aimed at generating long-term returns on investment through interest payment to the investors, while the borrower will get the time to pay the principal amount only at the end of the tenure. Now, the sources cited that, according to the new terms, Byju's and the group of lenders have agreed to work collaboratively towards a signed and completed a term loan amendment prior to August the 3rd, 2023. Now, if the loan term is successfully reworked, then the creditors would drop their demand for accelerated repayment. Now, further, all ongoing litigation could come to an end, while avoiding an enforcement actions initiated by the lenders.
All right, with that, we'll slip into a very short break. Then we'll look at all the stocks that you should be keeping on your radar for this trading day as we come back.
Great news for those who want to rise with India. Now you can get the full download of business, economics, leaders, interviews, analysis, anecdotes, profits, research, results, revenue, bulls, bears, bonds, markets, and more. Your new high seat of business news is here, etnownews.com. Great news for those who want to rise with India. Now you can get the full download of business, economics, leaders, interviews, analysis, anecdotes, profits, research, results, revenue, bulls, bears, bonds, markets, and more. Your new high seat of business news is here, etnownews.com.
Welcome back. Here watching Market Cafe with me, Ankita Saxena, and with me is Snehi Shah. And it is that time of the show where we tell you all the stocks that you need to keep on your radar for the trading session. And for that, I have my colleague Ashesha joining us. Ashesha, tell us what are the stocks that are likely to move in the markets today?
Well, yes, first up, let's talk about Vedanta. It reported its numbers post-market hours on Friday. Fairly weak set of numbers. Management commentary too has been muted. Revenues were slightly above what the street was working with, but margins have been below. As far as their semiconductor foray is concerned, management has said that they will announce capex in the coming foreseeable future after the feasibility study has been completed. But all in all, street is disappointed with the kind of numbers that it has reported, and also on account of capex that the company will have to incur on its semiconductor foray. Apart from this, IGL will also be in focus on the back of its results, where revenues are down 8% on a sequential basis. Remember, lower gas prices is why revenues have declined on a quarter-on-quarter basis. EBITDA per SCM, meanwhile, has seen an uptick of nearly 37%, and volumes have been lower than expected. Remember, first quarter in any case for IGL is a seasonally weak quarter, but this time around volumes have been lower even as compared to estimates. Moving on to PFC then, the company has signed memorandum of understanding worth about 2.4 lakh crore with 20 companies in the clean energy space. On account of this agreement that the company has entered into, PFC will also be in focus today. Also keep an eye out on SJVN, where the company has secured financial assistance to the tune of 50,000 crores from REC. They will be setting up new power generating stations based on conventional and renewable sources of energy. A whole host of pharma companies will be in focus on the back of US FDA action and their announcements that have taken place over the last few days. First up, let's talk about Biocon, where the company has received 8 observations in Form 483 from US FDA for its facility, which is located in Malaysia. Aurobindo Pharma, meanwhile, has received 3 observations, Form 483 from US FDA with respect to its plant in Telangana. Lastly, Shriram Finance, on the back of some MSCI action, where MSCI will be increasing the free float of Shriram Finance. Increase in the free float is on account of Piramal Enterprises increasing its stakes. On account of this reject that is happening, this counter will also be in focus today.
Alright, thanks Ashesha for all those stocks to watch out for. We will be keeping an eye out on all these stocks. But Vamakshi is also joining in to take us through what the brokerages are keeping on their radar. And Vamakshi, over the weekend, we've got a slurry of results coming in. You've got Reliance, ICICI Bank, Paytm. So take us through what the brokerages are seeing for these stocks now that they have declared their Q1 numbers.
Well, yes, a very good morning to you. Let's first start off with Reliance. We have a note coming in from Goldman Sachs, and they have highlighted that they did see robust grocery growth as well as retail EBITDA margin for the 5th consecutive quarter. Now, Jio saw a sharp increase in subscriber growth as well, and the energy segment declined only by 4% despite the sharp pullback that we saw in the GRMs. Other than that, they also highlighted that recovering GRMs and gas volume growth could support the sequential growth going ahead. So largely on the back of that, we have Goldman Sachs maintaining a buy rating on Reliance with a target price of 2,725 per share. Other than that, we also have ICICI Bank on our radar. We have a note coming in from CLSA. They have highlighted very strong growth, and management is also appearing to be quite confident. NIM moderation was seen, but this was largely in line with expectations, and the deposit accretion has now started to pick up pace, so which is another positive for ICICI Bank. In fact, CLSA highlights that the bank has the highest earnings certainty over the next 3 years, which is why it is a top pick, and that is the reason why CLSA has not just maintained its buy rating but also hiked its target price on this counter to 1,225 per share. Other than that, we also have another bank on our radar, Kotak Mahindra Bank in focus. We have a note coming in from Investec. They have highlighted that the liabilities momentum is seeing an improvement, the asset quality remains best in class, and they believe that the NIMs should stabilize at the elevated levels of almost 5%. So on the back of that, we have Investec maintaining a buy rating on Kotak Mahindra Bank with a target price of 2,300 per share. And lastly, keep an eye out on Paytm. We have CLSA maintaining its buy call on Paytm, and not just that, they've gone ahead and increased the target price by 200 rupees per share to 1,050 odd rupees. They have highlighted that there has been an improvement in the payment net take rate, and that has come in as a positive surprise for Paytm. They're scaling up their lending business, and the ticket sizes are also increasing. So largely on the back of that, CLSA has maintained a buy on Paytm, and given all these brokerages, keep an eye out for these counters.
Absolutely, Vamakshi. We will be keeping an eye out on all the counters that you mentioned. But the steel major Tata Steel will be in focus on the back of its Q1 earnings. And Ashesha is joining in with what the street is really penciling in for the steel major.
Well, yes, higher raw material costs and underperformance of European operations is expected to impact Tata Steel's numbers this time around yet again. On a consolidated basis, revenues are expected to come in at about 57,000 crores, which on a sequential basis will be a decline of about 9%. Margins, meanwhile, could come in at 9%, sequential decline of about 250 basis points. As far as European operations are concerned, they've been a pain point for the last many quarters. This time around, it's going to be no different. EBITDA per ton for European operations is expected to come in at negative $92 per ton versus a loss of $95 per ton that the company had reported in the previous quarter. Weak demand, shutdowns is why Europe has been a pain point, and it is going to continue this quarter as well. As far as India operations are concerned, realizations are expected to be flat or increase marginally. EBITDA per ton, meanwhile, is expected to be declining by about 37% on a sequential basis due to flat realizations and higher coking coal inventory that the company has been sitting on. All in all, weak set of numbers are expected. Consolidated revenues are expected to decline by about 9%, and European operations are expected to be weak this time around.
All right, thanks to Shesha for all those details. We will be keeping out an eye on the Tata Steel's numbers, but Shriram Finance will be in focus after Piramal Enterprises sold stake in the company last month. which now implies that the company's MSCI free float will increase. Vamakshi is joining in to explain what this means for the stock. Vamakshi.
Well, yes, Shriram Finance in focus on the back of that news flow. Let's first look at what MSCI index actually means. So now on July 24th, the MSCI will be increasing the free float of Shriram Finance, and increase in this free float is mainly owing to the stake sale that was conducted by the Piramal Group. Now let me just give you a brief background. Now in 2013, Piramal had acquired nearly 10% stake in Shriram Transport Finance, and in the very next year, they ended up acquiring nearly 20% stake in Shriram Capital and 10% stake in Shriram City Union Finance. So all in all, after the merger, Piramal Group held nearly 8.34% stake in Shriram Finance, which they then offloaded on June 21, 2023. So now they were definitely long-term shareholders, and in fact, the stake sale that they did back in June implies that there is now a higher free float available. Now keep in mind that in MSCI indexes, free float adjusted market cap is actually used to determine higher weightings for the stock. So which is why when the determined free float rate actually increases, the index, the weightage in the index is expected to increase, which in turn means that Nuvama is expecting an increase in the free float to lead to an inflow of almost $70 million, which is equivalent to nearly 3 million shares or nearly 1.7 times 20-day average volume as far as Shriram Finance is concerned. So given this news flow, keep an eye out on Shriram Finance.
All right then, Vamakshi. Thank you so much for all the details. But Credit Access Grameen has also reported a strong set of Q1 numbers, and Vamakshi is here joining us again with all the number crunching. Vamakshi, take us through the numbers.
Well, yes, overall it was a very strong show as far as Credit Access Grameen is concerned. Let's look at their loan book. We are seeing some very strong loan growth out here. The gross loan portfolio has gone up by almost 40% on a year-on-year basis, which is in fact much higher than what the company had guided for. They were estimating a loan growth between 24 to 25%, and that is definitely surpassing their FY24 guidance. And not just that, their NIMs stand at 13%, and they have improved year-on-year as well as sequentially. And in fact, they have come in much higher than their guidance of around 12%. As a result of that, their calculated NII has gone up to almost 720 odd crores, an uptick of almost 58% is what they're reporting. Now, we also saw that their cost efficiencies have improved, and that can be actually attributed to the declining OPEX to AUM ratio. As a result, pre-operating provisioning profit has come in nearly 87% higher at 542 odd crores. The net profit has more than doubled for this counter, coming in at 346 odd crores, and this is in fact much higher than what the street was actually anticipating. And all of this growth has actually come in coupled with good asset quality. The asset quality has seen a marked improvement. GNPA stands at 0.89%, falling below the 1% mark, while NNPA stands at 0.2%, improving by nearly 8 basis points on a sequential basis. Not just that, the management has also come out with a very strong outlook. They are aiming to surpass the 25,000 crore loan portfolio mark during FY24, which is their 25th year of operations. And in fact, they have also highlighted that over the course of the next 4 to 5 years, they're expecting to double their loan portfolio to 50,000 odd crores. And they are also quite confident of achieving their FY24 guidance, which they have already on a lot of counts. So largely, all in all, it looks like a very strong show as far as Credit Access Grameen is concerned. And on the back of that, watch out for this counter.
All right, thanks Vamakshi for all those details. Credit Access, a solid set of numbers coming in for that. But with that, we're completely out of time on this edition of Market Cafe. Don't go anywhere, the market takes all the action.